Hello and welcome to the What the Finance podcast, where we talk to experts about all things finance. If you get value out of this episode, please subscribe so you don't miss out on any in the future. I hope you enjoy. So, Adam, thank you very much for joining me today to talk about your new book, The Complete Financial History of Berkshire Hathaway. So, I'd just like to start by asking, what is your motivation for writing the book?
Yeah, I guess I wrote the book I never found, Anthony. I've been studying Buffett for probably close to 20 years, and as Chris Bloomstrand noted in his foreword to the book, there's over 200 titles on Berkshire, and so I think any sane person would not set out to add something to that crowded field. But I basically wrote the book that I wanted, which was Berkshire A to Z, kind of geek out on the financial statements, um, and really go deeper, but not try to uh, outdo Buffett, if you will. I mean, he has his letters out there, and those are great. But what I found myself doing from time to time, more often than not, was going from Buffett's letters and saying, "Well, how did he get this number that he referenced?" And I'd go into the 10K, I'd calculate it or find it, and I really wanted to bring all of that sort of forward. And so the book, uh, hopefully, is my way of giving back. If there's other, kind of crazy people like me out there that would enjoy this, um, I'll be happy if they pick it up, and it deserves a place on their bookshelf.
Yeah, definitely. I found that interesting how a lot of the things he did were very revolutionary in terms of accounting, and he'd always go against what was the norm at the time.
Yeah, Buffett, he's very realistic. I mean, right when he took over in 1965, you can see this history. And it was the accounting at the time. I mean, he very much. I think I I used the term economics versus accounting over and over and over in the book. Um, but wherever the accounting is, Buffett always tries to tell reality. And so, um, there were times in the early days where they would write off plant, but it would be below the line. So it would be basically, hidden, if you will. But accounting conventions didn't require that be noted in the income statement, but he would highlight it. And so Berkshire, his communication over the years has really been an exercise in communication, and that's why we all love him so much. He's a very effective teacher, in addition to being very wealthy, which is another reason why we love him so much.
Yeah, and would you say that's sort of what attracted yourself to enjoying researching?
Yeah, I grew up in a family of business owners. My grandfather had a tree service business. My father was in trucking and then real estate. I sold firewood. I had a welding business. I've always been in the business world, if you will. I've sort of always absorbed it. And it was kind of like Buffett said when he read Graham for the first time, where the scales just kind of fell from his eyes, and it just instantly resonated with me. And so, I guess you can't help but operate anywhere in the business or investing world for any length of time and not cross paths with Warren Buffett or Berkshire Hathaway in some way. So once I hit that, I was sucked in, and I'm never getting out.
Yeah, exactly. Yeah, for life, like Warren. So for any, I'm sure everyone's heard of him, but might not know sort of the specifics about his philosophy and how he invests. So can you go a bit more into that and sort of value investing?
Sure, sure. So at the very core, uh, Buffett's philosophy is one of buying businesses, and that's something that's fundamental before we even get to anything else, and that comes from Benjamin Graham, who is really the father of security analysis. Ben Graham operated 100 years ago. He lived through the Great Depression. He was Buffett's teacher, and so this fundamental stocks are a business is core to everything. Uh, Graham was a very quantitative person, and so it fit with the period in which he came up with this quantitative approach of finding stocks net, which just means add up the cash and the current assets on the balance sheet, and you could buy the company for less than that even after subtracting all the debt. And so Buffett's value investing philosophy started as what he called a cigar butt approach, which was just finding these sort of rundown companies. The operations themselves weren't really that good, but if you could buy the whole company and sell everything, theoretically, and in some cases, in actuality, you could just take that capital and you'd be buying, in some cases, really the cash on the books for much less than was actually there. And so this quantitative approach stayed with him for a long time, and that's ultimately why he bought into Berkshire Hathaway in 1965 as a struggling textile manufacturer. And then Charlie Munger, who's 97 and still vice chairman of Berkshire Hathaway, enters the scene in Buffett's life in the 50s, but then really gets involved in Berkshire Hathaway in the 70s. And you see this shift to qualitative businesses, See's Candy. Then we get into the Buffalo News, which at the time was a very good business. They bought Coca-Cola, a big investment in Coca-Cola. And so you see this shift to better businesses. But at its core, Anthony, it's still looking at a business, looking at a stock as if it was a business, trying to determine the cash flows, and then valuing those cash flows. Very much the opposite of speculation and the speculative fever that we see around us today.
Yeah, and I think that's something that's sort of mentioned throughout the book, where he, as you said, he evolves from that, just trying to find a bargain, and then sort of, I think it was very in and out to start with, and then that evolved to more long-term investing. And even if it's a bit more expensive, if it's a quality company, then they're going to put money into it.
Yeah, Berkshire, as it grew and it didn't pay a dividend, they would be forced into the strategy almost inevitably, because the sums of capital were just accumulating so quickly, and you really can't flip businesses with billions and billions of dollars. I mean, it really just doesn't work. So it was a double whammy, but I think they would have gotten there eventually.
Yeah, perfect. And you mentioned sort of obviously Warren getting involved in Berkshire Hathaway, and it's something that I think some people think he founded it, but obviously throughout the book you mentioned that he buys a company. So can you explain a bit more about sort of the early years of the company and his first involvements?
Sure. No, it's a very good question. And in some ways, the answer is yes. Yes, he did found it, but yes or no, he didn't. Because technically, Berkshire Hathaway, the name stems from Berkshire Fine Spinning and Associates, which itself was a conglomeration of multiple textile plants, multiple textile companies that came together in 1929. So that was Berkshire Fine Spinning, and then Hathaway Manufacturing operated on this sort of parallel track until 1955, when the two companies merged, Berkshire and Hathaway, Berkshire Hathaway. And so technically the business dates back to the 1800s, and I touch on that in the book just as a primer, because I think it's the full business history. And actually, when I first told Buffett that I was writing the book, he suggested that I go back to the World War II period. I said, well, if I'm going to go back this far, first of all, I'm going to do it because Warren Buffett suggested it, but I decided to just go all the way back to the very beginning. And so I think it's an interesting story, but I think it also highlights just sort of basic business concepts. But that's kind of an aside. But really, I mean, when you look at the business of yesterday, of 50, 75 years ago, Buffett really did found Berkshire Hathaway. I mean, we very well could be sitting around here, Anthony, talking about Warren Buffett and blue chip stamps, because that was another company that they had a controlling position in. And so Berkshire just kind of became Warren Buffett's investment vehicle. Eventually, he sold his partnership or wound his partnership down, and Berkshire became the sort of main vehicle. And so technically no, but sort of yes.
Yeah, he founded it in that part of it. It definitely evolved quite a lot since he got involved.
Yeah, I mean, and really, it's an exercise in capital allocation. I mean, you know, if you found a business, you're gonna have investors, equity capital, debt capital. You're gonna take that capital and invest it in something. Well, he just took the textile business, uh, shrunk it down, took the capital from that, and reinvested it. So, in that sense, he really was the founder.
Yeah, definitely. And another thing that I found interesting that you mentioned is that he talks about how he made a mistake sort of using Berkshire Hathaway as that vehicle for the conglomerate. So, yeah, can you maybe expand a bit more on that and why he thought that?
Yeah, I think he references it specifically with respect to national indemnity, where Jack Ringwald, who founded National Indemnity, um, uh, Buffett and Ringwald got together. Buffett was kind of pursuing this acquisition, and Ringwald had, you know, the famous sort of bad day and said, "No, I just want to sell my business." And so Buffett picked it up, and Buffett said, "Geez, I would have been better off buying National Indemnity, just creating an LLC or a separate corporation at the time, and just buying it, you know, myself. I could have raised the capital," he said, "but instead, I married this very good business, which was National Indemnity, the insurer, with this dying textile business." And so, at the time, I think he quantified it as maybe $100 billion worth of wealth. That because of that, he essentially gave these shareholders of Berkshire Hathaway that hadn't invested through the Buffett Partnership Limited in the early days, essentially gave them a free ride, and what a ride it has been.
Yeah, it's very lucky to get in to be in that at the beginning, wouldn't it? Sort of another point that's talked about is one of the major factors behind his growth is sort of the insurance business, and you mentioned it there. And large float he has. Can you explain a bit more about sort of the insurance business and the float and sort of why has it been so important for Berkshire Hathaway?
Yeah, I mean, he really, gosh, you could even say so. They acquired National Indemnity in 1967 for $8.6 million, and you could basically say from that time on, Berkshire was an insurer, and even today, it's a huge part of their business. I've used I think I used the term rocket fuel in the book to describe insurance. The characteristic, and they didn't figure this out until actually later, Anthony, as you know, just the value of float. And float is simply monies that an insurer holds but has not yet paid out. So it's other people's money that it holds, but it gets the benefit of it. And so you pay your auto premium in advance. That's money on deposit, or you get in an accident and they haven't yet paid it out. That's also money that they're holding on to. And so, um, if an insurer can invest that and their underwriting breaks even or has a slight loss, this cost of float, this pool of capital, is incredibly valuable. Now, the problem is every other insurer sort of knows this, and so you have this competition for float for these premiums, and so that drives down the underwriting profitability over time. But what Buffett, through some trial, by the way, I mean they had some years of losses, figured out that if the focus could primarily be to underwrite to break even, profits great, but break even, the float, this pool of capital, which today amounts to $140 billion, is an incredible asset. And it took me actually a while to really think about Buffett's comments that he's made over the years in his letters, in talks, in the annual meeting, Q&A, that float as structured by Berkshire Hathaway really functions like equity. And it's kind of this weird thing to get your head around, but I think I describe it in 1995, the section on 1995 of the book, where it's sort of this revolving fund, and it really does function like equity, but it has provided the leverage to Berkshire Hathaway in a very important way that, unlike debt, float can't just be called away. It's something that revolves over time, and so as presently constituted, uh, if it declined, and it's been very resilient, it would be a very slow pace. So it's an incredible asset working in Berkshire's favor that is not really as well understood as I think it should be, especially given the prominence of Berkshire.
Yeah, it was definitely one of the main things I sort of learned in the book, the importance of it. And I guess the sort of interest rates at the time as well probably had a big, so I'm guessing they earned quite a lot uh, through having that massive amount of cash earning interest on it.
Yeah, I mean, you think about it, Anthony. If I'm the insurer and I'm going to insure, you for a year of automobile insurance, and if it's £1,000, I'll use pounds, but whatever the currency is, if it's $1,000, you're giving me. Um, I mean, if interest rates are 10%, if government bonds are 7, 8, 9, 10%. I mean, I get to earn money off of that. You get nothing from it. Now, the problem, as I just described, is every insurer knows that. And so in an interest rate environment that's that has higher interest rates, they'll say, well, I'll on average let my insureds get into accident. We'll pay out slightly more than we pay in premium. So to continue that example, if all of the customers ultimately cost um, my little hypothetical insurance company $1,050 throughout the course of the year, that's a 5% cost. Well, if I can make 10% on that $1,000, I'm plus $50 to this whole thing. So that's the basic concept. I'm probably not doing a great job explaining it, but that works its way out in various fashions throughout time and throughout the industry. But Berkshire has really figured out the secret sauce, how to make it all work in basically every area of insurance that's out there.
Yeah, definitely. I think it's something that you mentioned in the book as well, and he mentions quite a lot. Where if they have a good year, then he's warning that there's going to be lots of competition in the next few years, but I think they were very disciplined up until they made an acquisition in the late '90s, which is probably one of the issues that they had, that it wasn't the company they thought. But yeah, as you said, it was all about just having that consistency and making sure that they're not doing what you said other companies are doing. They're actually doing premiums that are profitable for them.
Yeah, there was a period there, I think between 82 and 92, where they lost about $500 million from underwriting. Now they had insurance, they had investment income that more than made up from it, but they were trying to figure this out. And auto is a short tail insurance, which means that it's just 6 months, it's a year. You get quick feedback, and so there were times they formed a couple of insurance companies that failed. They had a home and auto business in Chicago that they tried to replicate in Miami. They didn't have that feedback loop, that information loop, and so they were writing policies, and they didn't know that they were losing money on it. I mean, which is, it's just kind of crazy to think about it. It's like if you're a retailer and you know that the product on your shelf is selling for less than your cost, but you don't know it, or it's that feedback loop, that time between when you get the money and when you make the commitment and when you actually find out your profitability often lags quite a bit. But Ajit Jain came in 1985. They really figured it out, and there were some bumps along the way. But you're right. I mean, the basic point of that lumpiness that Buffett talks about, especially when they got into the super cat insurance, some of the reinsurance lines, where I think right when they got into it, they had quite a long string of this abnormal plus profitability, where Buffett, you can just see him saying, no, like, don't get used to this. Don't, adjust your estimates of Berkshire's earnings down. This is not normal. And so again, it just shows his communication, which has been excellent.
Yeah, and I think it's quite interesting. He's almost the opposite to every other sort of manager or person who they're always talking up what they're doing in the future, whereas he's always telling it as it is.
Mm-hmm.
Yeah, definitely. So I'm going to move on, because we talked about insurance, but a lot of the sort of revenue as well came from a lot of companies that they didn't really have the growth potential. So they didn't, they were these really well-run companies, but they didn't really have any potential to grow. So I know it's quite ambiguous, but, what would you say would be the major attributes of a perfect company, sort of in Warren's eyes, to invest in?
Well, the perfect company is, I think Buffett described it as, a company that earns high returns on capital, but can grow. And so that growth factor is really key. They bought See's Candy in 1972 for net $25 million. That business was earning something like 50% on capital. That's great, but it was a business that couldn't grow. And they tried. I mean, they saw, if you have a business earning 50% on capital, you're going to do everything you can to try to expand, right? It just wouldn't stick outside of Southern California. But that insight led them to, I guess I'll use this because I think it's a more tangible example than just something theoretical, but Coca-Cola really was that perfect business. When Berkshire started investing in it in the 1980s, it had those Seas-like returns, but it also had this enormous runway for growth. And so Coke, things have gone mixed up over the years between bottlers and so forth, but the original business of Coke and sort of the core business is not selling the finished product, but actually selling the syrup. And so if you can manufacture this syrup, ship it across the world, and then add the water and the carbonation there, the economics are just incredible. And so Coke's real main advantage was its distribution system, and that was basically the perfect business. A cheap commodity input, just basically ingredients, caffeine, a little, food coloring. It was colored sugar water, caffeinated colored sugar water, that they put a brand on, and then you had this tailwind of growing wealth around the world as well as growing populations, and so it was just this dream of a business. And but those are hard to find, and even when you find them, they're often at a very expensive price, which is the other key element.
Yeah, definitely. You mentioned return on equity there. So why do you think that, because obviously that's sort of one of the main thing that I think Warren Buffett, he mentions throughout 50 years. Why do you think that's such a sort of a vital statistic for him to analyze?
Well, and maybe you're referring to in specifically Berkshire's case with book value growth and that.
Yeah. So I think it was a return on capital, or return on equity.
Yeah, and I was going to just make the distinction and kind of go a little bit deeper there. I think that's what you were asking.
Yeah.
Which was in Berkshire's case, because they really used debt very sparingly. Return on equity was a good metric, which growth in book value, that's basically return on equity for a company that doesn't pay a dividend. But the real metric that Buffett looks at that sort of normalizes every business is return on invested capital. And so return on equity can be artificially skewed by the level of debt that's on the balance sheet. And so Buffett said, I want to look at this business as if it was 100% equity finance. So, no accounting gimmickry, no financial engineering. Is it at its core an excellent business on an operating basis? Financially, as well as, just the basic economics of its competitive position and its moat and so forth. That basic viewpoint, that's how I looked at the acquisitions in the book, I think is really how he views all companies. And you can see even today, and you listen to Buffett talk about the competition in terms of both interest rates and the availability of capital and the willingness and ability of companies to borrow money. They can't find businesses to buy at reasonable prices, but Berkshire has always looked at businesses through this lens of return on invested capital, which if they don't employ very much debt, that return will basically translate into a return on equity.
Yeah, definitely. I think what we've seen sort of over the past 50 years of growth is it's really a story of compounding returns, isn't it, over sort of 50 plus years. So if you look at him, he's quite unique in that regard. So why do you think that he is so unique in just how much he has compounded over those 50 years or so?
Yeah, it's you know, almost inevitably. I mean, but it really is Berkshire Hathaway really is this incredible system. I mean, but Buffett has thought very, very deeply about so many businesses, but so many aspects of businesses, and really, I mean, how they interact in the world, and just all of it. They really figured out how to maximize human potential. I mean, that's how I put it in the book: human and business potential. And businesses really are systems that combine inputs, and a big input is are humans. Um, but Buffett had and has had the ability to generate good returns through his acumen over a long period of time. And so, just by virtue of retaining uh, earnings over the years, I mean, when I look at the equity capital, I do this sort of roll forward every chapter, which covers a decade in the book, and say how did equity grow during that period of time, and what was the contribution of each each decade to the whole. And if you just look at the last 5 years, which in the book is 2015 to 19, all of the capital ever generated by Berkshire Hathaway in 5 years, those 5 years represent about 40%, over 40% of the total capital. So compounding, you're right, is this non-intuitive. It seems like magic because we're so used to a linear world. Um, so just by virtue of retaining all of that capital, Berkshire had this huge growth trajectory, and so you just have this sort of magic, Anthony. I mean, really, Berkshire started at the end of sort of the bust of the old conglomerates, where they kind of were doing these crazy things with accounting and so forth, and just playing. So he learned all these great lessons, but then they were able to sort of grow up, if you will, and find these great businesses like Seas and like Feckheimer and like Scott Fetzer earning great returns on capital that were available. Nobody wanted them. It was just crazy. So this was a huge tailwind. A guy that continually learns. He's really good at business, not just picking stocks, but finding good businesses. And then you couple that with retaining all earnings, and it was just, to use Charlie Munger's term, it was a lollapalooza. It was just one thing, on top of the other, and it was just, it's just incredible what has been built over the last, 60 years or so here.
Yeah, and I found it funny in the book you mentioned sort of he started putting an advertisement at the start of his letters, sort of asking for companies, and a lot of the acquisitions he made were just sort of chance encounters. And I know also when he met Charlie Munger, I think they met at a friend's place or something, which is another chance encounter. So it was almost like a lot of the time they weren't, they're learning and they're looking at businesses, but a lot of the things that they actually invested in or that worked was just by chance, basically.
Yeah, Berkshire has had this strategy of no strategy where, they don't sit around every year and say, okay, we need to go into this business line, or we're going to try to acquire this business because it looks good. It's really just sit around. And when I sit around and answer the phone, but sit around means, really studying the business landscape, getting to know these businesses. I mean, when they bought Flight Safety, which is a flight training business, which I think they have a big operation over there in the UK. Buffett had been reading that report for years, where he talks about reading the IBM report for 50 years before. So he's followed these businesses for years and years, and so that's why he can make these quick judgments. But he really is a good businessman, and so it's really, there was a lot of work in the background the saying that luck favors the prepared mind, or that he and they have done a lot of work in the background, and there are one question I wanted to ask Warren, and I had sent in my question this annual meeting. It said, tell us about some of these acquisitions that you never purchased, that kind of failed or went through, or what happened, because we never get to hear about those, right? I mean, Buffett's been very candid about his mistakes, but we haven't really had much of an insight into what Berkshire has passed on, or deals that fell through. But there's a lot that goes in the background to making it look easy, I suspect.
Yeah, definitely. I guess we only see most of the time we only see the winners, don't we? Yeah. So we'll go on the book. So it's quite long. It's over sort of 700 pages, and it outlines the company's history. So sort of how would you suggest readers utilize it for their own investing, or just in general?
Yeah. So I hope. So if you're a new student to business or Berkshire Hathaway, that student or investor can read it A to Z and sort of relive or live through the history. I mean, you and I are younger, or you think about someone 10 or 20 years from now, that person needs a way to sort of relive the history of Berkshire Hathaway. And so for that brand new person, I hope that they can sort of relive it. I've given some basic overview of kind of like what the economy looks like, what interest rates look like at the time, and just kind of relive that history. I mean, when we talk about having that decade of underwriting losses, I mean, think about living through a whole decade just painfully year by year, and you can kind of I hope you can feel that it really comes out, that pain from year to year. So if that new student or investor has a way of sort of reliving Berkshire's history year to year, picks up some basic business terms, accounting terms, investing techniques, many of which are explained by Buffett, and I let him speak when possible. That's sort of one group. And then if you're an experienced investor, if you study Berkshire for a while, it may serve as a reference book where you can kind of go back and say, oh geez, I want to relive the history in the 70s, or a couple of years when inflation was really high, and kind of re-watch Berkshire during that time. And then separate to the book, you mentioned the 750 pages. That was getting quite thick. So I created this website called theoraclesclassroom.com, and I put much of the research material that I found on the website. There's a glossary. There's my 200-page or 200-tab Excel file out there, and then there's all kinds of annual reports and Moody's files actually dating back to the 1920s and 30s on the early the Berkshire subsidiaries. So I hope it serves as a resource for others studying Berkshire and business as a whole.
Yeah, definitely. So obviously you got the book and then that expanded encyclopedia, basically. It's great. So was there anything sort of when you were researching that you learned that sort of surprised you about the business at all? Or?
Yeah, I came to appreciate Berkshire much more for the whole and just everything we talked about. We talked a little bit about the float and how it functions as equity. I mean, that really hit home to me, and just really, I hope I've conveyed that piece that I've learned in the book. But when I paused at the 50-year mark, which was 2014, and looked back and said, I looked at the largest acquisitions in Berkshire's history as a percentage of equity capital at the time. And you often hear the concentrations in the stock portfolio, which Apple was almost half of the portfolio, or the top four represent about 75%. And that has been pretty consistent, and people have talked about that. But what I did in the book was I said, I'm going to look at the top two acquisitions as a percentage of Berkshire's equity capital at the time of acquisition. And the largest was actually a little bank they bought in 1969 called the Illinois Bank and Trust of Rockford, Illinois, which was 44% of their equity capital at the time. And so you sort of see Berkshire as this continual sort of not only in the stock portfolio, but in whole businesses of just buying bigger and bigger and bigger businesses. And so when you look through Berkshire's history, I think it was the 84 decade, the largest was 15%. And then the next 3 decades were about 18 or 19%. That just shows you, when you think about Berkshire's equity capital today at about, call it 500 billion, they have to find an acquisition of $75 billion just to kind of keep up that track record. So it shows you how hard it is. It shows you the power of that compounding and sort of leads into this natural train of thought where Berkshire's going to have to start returning capital to shareholders. And so that was kind of interesting to me. But there's a whole ton of things that I learned, and like I said, there were the insurance businesses that they founded, and even Berkshire, Buffett's. I don't touch on Buffett's life really in the book, or his personal or investing outside of Berkshire pre 1965. But it was interesting to me, Anthony, to see this sort of entrepreneurial spirit that Buffett had in his childhood of reselling Coca-Cola or delivering newspapers or reselling golf balls or pinball machines. That manifested itself in Berkshire Hathaway in the future, where he was pushing Geico ahead, even though the accounting showed that they were making losses or less profit at the time, or trying just to open up new insurance businesses, some of which failed. You really see Buffett, the entrepreneur, come out, and I just thought that was interesting when I kind of stopped and took stock of that after getting all the way through.
Yeah, I guess it's an interesting part when you look at it. Like when he got into Berkshire Hathaway, he was in his sort of early 30s as well. So it had over 10 years, even though it's sort of almost 60 years ago. You look at it, he did have that experience of working at, in other aspects, and as you said, building that entrepreneurial mindset before he actually got into the business.
Yeah, it really is. It's a shame that people only think of him as a great investor, or because he really is a great manager, and he can really motivate people, and that entrepreneurial spirit of I mean, he, as recently as I want to say it was about 10 years ago now, he thought that Geico policyholders, which historically Geico has focused on safer drivers, Buffett reasoned that these safer drivers would be better credit risks, and said, let's have Geico offer a credit card. Interestingly, Geico's management said, no, this is a bad idea. Buffett said, no, let's do it anyways. They ended up losing $50 million. And Buffett, again, to his credit, he comes out in his letters and says, I made this dumb mistake. I pushed them to do it. It was only me. But it shows his willingness. And I think that what underlies that, Anthony, which also touches on insurance, but happens outside of insurance, is this risk reward. He really looks at things through the lens of probabilities and says, okay, well, if this works, this could be really great, but I'm willing to risk $50 million on this. So you see that from time to time within Berkshire, and that's really very much part of the Berkshire culture. And even, I mean, just as recently as a week or so ago, MyTech came out with this modular home construction project, and again, others have tried and failed in this area, and time will tell how this ultimately plays out. But you do, if you look closely, you can see Berkshire really continuing to innovate and continuing to be entrepreneurial, even today.
Yeah, definitely. And you look through the book, and some of the numbers of the losses is, they just seem so large. But then you think about the size of the company, and as you said, the flow that it has, it's just not really. It's all within that risk that they're sort of focusing on, isn't it?
Yeah, and insurance specifically, they were the ones that insured this Pepsi $1 billion challenge, or I think they insured, like Mike Tyson's $1 ability to fight, and maybe Alex Rodriguez's A-Rod's arm or something. I forget what, just these kind of crazy, weird risks. But they say, hey, we're willing, as long as the odds are in our favor, we're willing to tolerate pretty large losses that others might not be willing to do. And so, but I mean, that Pepsi challenge, for example, just specifically, I believe the odds were 1 in 100 of someone winning $1 billion. They got paid 1 to 10. So the margin of safety in this was huge. And they would make that bet over and over and over and over again, even if someone won the first time. I mean, they would continue to make that because they've reasoned through it, and they've judged the odds in their favor. And so you can see that in different ways, but specifically within the insurance business.
Yeah, and just doing that over 60 years. So
yeah.
On to my last question. So what, if there's one message that someone could take away from it, what would you think that should be from the book?
I maybe I'll go back to where we started this interview, Anthony, and just and really, I mean, I'm clearly biased to Buffett and Berkshire and this value investing, but stocks are businesses, and that will ever remain true. And I think just this Berkshire as a representation of good business dealing and honesty and operating just above board and continual learning, that the examples that are used in the book that come from Berkshire, those will fade over time. They will look like security analysis, and where Benjamin Graham talks about these stodgy old coal businesses or railroads at the time. But the basic lessons will always remain. I mean, I am firmly convinced of that these are timeless lessons that anybody, I mean, business students, but definitely investors should really pick up and really understand the fundamental truths behind them. And I think that will serve you well, not only in investing, but elsewhere as well.
Okay, perfect. So Adam, thank you so much for joining me today. I know you were mentioning before that you have a newsletter that you're currently promoting. Can you explain a bit more about that?
Yeah, so my main day job, if you will, is managing capital for clients. But I started this newsletter called watchlistinvesting.com. It's a paid newsletter, and then I also have a free version on Substack, also Watchlist Investing. And it really, my investing approach, it won't surprise you to know, is very much based on this value investing, Buffett's philosophy of, kind of like we talked about before, just finding the good businesses and waiting for them to go on sale. And so that's where watchlist investing comes from.
Okay, perfect. So yeah, and I'm guessing the best place to find the book as well would be on Amazon, would it?
Yep, it's in all major bookstores. If you're outside of the US or the UK, I mean, you can go directly to the Harriman House website and find it there. The Oracle's Classroom or brkbook.com has a link to it as well. And what else? I'm on Twitter, BRK_student. Really, if anybody listening to this or anybody that reads the book, I'd love to hear from you. Just reach out. I very much, it was kind of coincidental that I had to use that underscore, but I really would underscore the point that I am still a student of Berkshire, of business. It's really something that will be this continual study over time. And so I hope I can give back to this community, and I'd love to hear from folks and help people understand Berkshire and investing as well.
Okay, perfect. Well, yeah, I'll put that all in the description below. So if anyone wants,
Awesome.
wants to find you, I'll put that down there. But yeah, Adam, thank you so much for joining me today.
This is a lot of fun, Anthony. Thanks a lot.
Cheers. Appreciate it. Bye.